Hello CIERRA, you're welcome to the reloaded version of the first video. The intention is to make you understand it better, so you admitted that you wouldn't mind a long video. So I hope that it's going to throw more light to make you understand the concepts better. I'm glad that you said that the majority of the concepts are familiar to you. Alright, or you are familiar with the majority of the concepts that was discussed. So like before, we are going to start with the directional bias. Our main focus is going to be on the daily directional bias. That notwithstanding, price is fractal. What happens on the weekly happens on the daily charts and also on the lower time frames. So the same thing that happens on the weekly happens across all the time frames. So whatever concept that is explained here also apply to the various time frames. Okay? Now the first concept, like before, I used 3 methods to explain the directional bias. The first method is where we have a candle distributing above at least 2 highs in the bearish scenario, or a candle distributing below at least 2 lows in the bullish scenario. So the strategy is this. Let's assume that we cannot see this candle. This candle has not yet formed by the time we came to the charts. So that means we are only seeing this candle, and this particular candle has successfully distributed above this high and this high. So we say that the candle has distributed above 2 old highs, okay? And that's not all. After trading above these 2 old highs, the candle ended up closing below them. Look at the close price, for instance, of this candle. Then look at the highs we are talking about. So this level is lower than this one and this second level. So we can say in summary that the candle distributed above these highs and closed below the highs. When that happens, we can expect this particular candle to be what? A bearish candle or a down close candle. If this is applied to the daily time frame, then we can expect this particular day to be a down close day, a bearish day. The implication is that you start looking for opportunity to take sales. Okay? There are several additional things that you're supposed to do. But firstly, you need to know the bias. You need to have a bias and trade according to the bias. Alright? The second method is what I would term the swing high and the swing low break method. Firstly, if you want to define a swing high or a swing low, we need 3 candles. Okay, and out of that 3 candles, we are focusing first of all on the middle candle or the second candle. For a swing high, the high of the second candle is higher than the highs of the first and the third candle. While for a swing low, the low of the second candle is lower than the lows of the first and the third candle. Okay? So that is how we define a swing high or a swing low. So what's the implication? Let us say that we have a swing low here. It is not represented diagrammatically. We have a swing low there. When we have a break in this instance of a swing high, here we have a break of this swing high and we have a retracement. What we should be looking for is a swing low. When a swing high breaks to the upside, we should be looking for a swing low to form. When a swing low eventually forms, the next thing you do is now to focus on the third candle. We are now focusing on the third candle's high. Okay, we are focusing on the third candle's high in the case of a bullish scenario. Let's say this is the third candle's high. You wait for the fourth candle to trade above this third candle high. If that happens, then you can expect the next candle, which is the fifth candle, to be an up close candle or a bullish candle. Okay, and expect the fifth candle to be what? A bullish candle. So for instance, if this is a daily chart, then you can expect this day will be going to the market with a bullish directional bias. Okay, so that means for that particular day you'll be looking for opportunity to enter for a buy. Okay, so that is what it means. You can also check by yourself the bearish scenario. For example, we have a swing low and we have a swing low break. We have a swing low break. What you should be looking to get is the formation of a swing low. Okay, you should be looking for the formation of a swing high. Alright, let's say these are the candles. One, first and third candle. Okay, we have a break of a swing low here, so we should be looking for the formation of a swing high. This is actually a swing high, so you now focus on the third candle. Alright, and wait if the fourth candle is going to trade through this third candle's low, in this case low. When that happens, you can expect the next candle, which is the fifth candle, to be bearish. Okay, but if you are using this system, ensure for more effectiveness that this low did not eventually break this low. Okay, this low should be higher than this low, or this high, this swing high should be lower than this swing high for it to work properly. Because as you know, if this swing low is broken, then most likely we have a bearish market. I don't want to confuse you or say too much things, but I believe you understand the point. Okay, this is the real chart. This is actually the weekly time frame, but we can apply it to the daily. So focusing on this candle, you can see that this candle actually traded above this high and even above several highs and closed below them. Look at the close. So we can expect a bearish week, bearish week, bearish week, even though this is not as good as I would want it to be. Coming to this candle, you can see that it closed below these two lows. Sorry, it traded below these two lows, or distributed below these two lows and closed above the lows. And so we expect bullishness in the upcoming week. Okay, now if you come here, this candle traded above this high and also traded above this high. I'm talking about this particular candle. Okay, and closed below them. You can see nice bearish week. Sorry about that, please. So looking at this candle, you can see what happened, and looking at this one is also very good. Closed, traded above this high, distributed above several highs, and closed below them. You can see the nice candle that formed, a nice bearish candle that formed. Okay, now for this case, you can see that it traded above this two high, cleared this liquidity, this approximately equal highs, and did what? Close below them. This is what all of these things we are doing. They are just stop points, but they are manipulations. Trade above and close below. So when the candle is trading above, it is simply inducing buyers. So anybody that ended up, those early buyers will be dealt with when the candle is coming down. So in this case, you see this candle trade above these two approximately equal highs, and then close below it. So you see that we have the next candle to be what? Bearish. After manipulating, the market is ready to go to the right direction. So that's what we are trying to say. Look at this example once again. This candle traded above this high and closed below them. We have bearish, bearish, and bearish. Okay. Now we have this one. In this case, we have this candle trading above this high, this low, distributing above these 1, 2 lows. Okay. But then, in actual sense, the candle actually closed higher than this low, but not higher than this low. In this case, this is not perfect. But in this case, we now waited for the next candle. The next candle became bullish. So when this candle is bullish, you can see that it has already closed above this low and this low. So it qualifies for a liquidity grab. So you now expect the next candle to be bullish, bullish, subsequent one will be bullish. Okay, subsequent one will be bullish. Now, look at this one. We have a break of this swing low. This is swing low. 1, 2, 3. Form a swing low. Okay, like we already explained. So once a swing low is broken, we should be looking for the formation of a swing high. And that's what we got here. We have a break here and we form this swing high made up of these three candles, 1, 2, 3. After forming the swing high, we are explaining the second method now. After forming the swing high, our focus will be on the third candle or the last candle, okay? On the last candle low. When the last candle low is traded through, then we expect the fifth candle to be bullish, to be bearish in this case, and the subsequent ones to be bearish as well. Alright, like I told you, some persons are very aggressive. They can just, once they notice a swing high formed, they can assume that the next candle, even the fourth candle, will be bearish and they start trading bearish. That is the aggressive way to look at it. Sorry about that again. Let's see how it goes. Now once again, we have the break of this low, break of this swing low. After the break of this swing low, what we'll be targeting is a swing high formation, which we got by this candle 1, 2, 3. So once the low, once the low is the low of the third candle is traded through, you can expect the fifth candle to be what? Bearish in this case. Okay. So there are more examples here. You can see that we have a break of this swing low. The next thing we start looking for is swing high to form. When we have the swing high form, you can see the number of bearish days that we have. This one now is what? Daily candle. So we have bearish days. Okay. So if you look at this chart, you can see a number of examples. If you look at it critically, you can see a number of examples that you can actually really capitalize on to really make you understand the process. Okay. Still on directional bias, this time the range system. So the thought process that we are going to be using in this case is, once we have a bullish break of structure in this case, okay, what we expect is a return to origin to mitigate probably an order block that led to the break of the structure before price continues. Okay, so if you're in an uptrend and you have a bullish break, you always expect price to retrace. If we're in a downtrend and you have a bearish break, you always expect price to retrace up. So that's going to be the thought process for this. Based on that, we have the daily, we have the 1 hour, we have the 15 minutes time frame shown. The daily, another point you have to take note of when you are on any chart, you focus on the most recent break of structure. Focus on the most recent break of structure. This method of directional bias is not as simple as the first two. It's not as direct as the first two. But I like it because it's quite powerful. Okay? Now, if you're on the daily or any of the time frame, focus on the most recent break of structure. That is going to tell you or define the bias in that particular time frame. So in this case, we have a bullish break of structure. So we can say that the daily bias is bullish. What is our expectation? We expect that price will not trade down to maybe this other block to continue the bullish move. Okay, so our expectation after a bullish break is always a bearish retracement or return to origin, RTO. Okay, when we see that, in our minds we know that the daily is bullish and we expect a bearish retracement. So we expect a downward price movement. With that expectation in our mind, okay, with that expectation in our mind, with this expectation in our mind, we scale down to a lower time frame. Let's say 1 hour time frame. When you are on the 1 hour time frame, you look for the most recent break of structure. On the 1 hour time frame, we have this break of structure which I call chalk, but I don't think it's properly to be named labeled chalk, but just take it as break of structure. We have this break of structure on the 1 hour and it's a bearish break of structure. So the 1 hour time frame is bearish. And what's the expectation after a bearish break? It's a bullish return to origin. So we can say that we are expecting a bullish move on the 1 hour time frame. Then going to the 15 minutes time frame, the most recent break of structure is bullish. So we say the bias for the 15 minutes time frame is bullish. And so we are expecting a bearish break. A bearish return to origin after the break of structure on the 15 minutes time frame. So, what is the essence of this? What's the usefulness of this? Now, if you start from the lowest time frame here, if you want to take trade now, what you do is you now go to the lowest time frame. You might be able to cite or identify a supply zone, a demand zone in this case, that led to this break of structure. So you may want price to come and mitigate it. Look for your entry reasons and take the price down to this block. Once you have been able to take the price up to this block, if you have been able to take the price up to this block, that means you have satisfied this expectation on the 1 hour time frame. You have made some good profit here, hopefully. Okay, so when that is done, the 1 hour time frame is satisfied. What is left is the daily time frame. You will now, even when you are still on the 15 minutes time frame, try to look for an opportunity to now get this move down to this daily demand zone. Okay, so you trade this, you look for opportunity to get this move down, so you can capitalize on this trade and capitalize on this trade, and by the time you finish, capitalize on this trade. This direction was bullish, you trade bullish. Capitalize on this trade, the direction was bearish. By the time you traded this, you have succeeded in trading the 1 hour. If you trade this, you have succeeded in trading this retracement. So your intention is satisfied. Okay, except you still want to continue. Of course, you should want to continue to now trade this. From here, you look for opportunity and trade this particular direction that is shown here. I don't know if you understand it, but don't worry, I'll keep explaining it to you. Okay, so that's the point we're trying to make. This one is not that direct, but it's quite interesting. Okay, it's like a top-down analysis. Then this is simply to throw more light to what we have discussed. Now the black is the daily time frame, the blue is the 1 hour time frame, the green is the M15 time frame, the 15 minutes time frame, while the purple is the 5 minutes time frame, the red is the continuation from the daily demand zone. Okay, so you can see that we have a bullish break of structure here. With this bullish break of structure, what are we expecting? We are expecting a return to origin. That's what we are expecting. Just this move is what we got by this complex pullback. No matter what this move did, it ended up coming down to this, from this point down to this point. So what confuses people most of the time in the markets are complex pullbacks. All of these ones are complex pullbacks. But if you know what you are doing, you can also profit from the complex pullbacks. Okay, starting from the daily, we have a bullish break. We already know that market should be coming down maybe to somewhere this daily demand zone. Okay, so what do? We scale down to the 4 hour. This is the 1 hour. This is 1 hour, and we look for the most recent break of structure, which is bearish. After we have a bearish, the next thing we expect market to do what? To return to this particular order block that is here, maybe the 1 hour order block. And you can see once again that all of this is just simply return to origin, a retracement, which is kind of complex. It's a kind of complex retracement to this particular block. Okay? And before we get that, we can even scale down. Immediately we see this break, bearish break, we can scale down to the 15 minutes. By the time you scale down to the 15 minutes, you now wait for, you see that this 15 minutes is actually bullish. You know that this retracement is actually beginning, okay, when you have this kind of break of structure here. So we have the break of structure sponsored by this 15 minutes demand zone. You can start, after the break of structure, bullish break, you expect a bearish return to origin. So we have this bearish return to origin. Okay, if you have a bearish return to origin, you start looking for opportunity to take the trade back up. Okay, so that you have a high risk to reward ratio. After this break, you look for the other block that sponsors this break of structure here. Then you can take your trade from here and capture this whole move. Okay, by the time you have done this, you have traded this, the next thing is to look for opportunity to come down here. Okay, so the same thing like what I explained in the previous slide, but this is just to throw more light on what we're doing. So after that, you now wait for a change of character here. By the time you see the change of character, you look for the block that sponsors the change of character. This was bullish and now bearish, so look for that block, this bearish other block, and trade from this point down and capture a very good risk to reward ratio down to this place. Then from here you can now start trading up to continue this the bearish move on the daily. Okay, sorry, let me go back. So when we are trading from here, your best target is going to be this high. Okay, by the time you get to this high, you should either close your trade or take very huge partials. Okay, by the time you get this high. Okay, why are you using this as target? As probably your final target, because if this uptrend is to continue, it's going to create a higher high and break this high. But meanwhile, take note, you can be using these levels as your partials, because liquidity rests above these highs. We have buy side liquidity here, buy side liquidity here. Okay, they are all here, so you can be using this as partials, and which is very, very advisable. And I hope you're getting it bit by bit. Okay, now liquidity. You mentioned something about liquidity, and I think I've explained it. There's nothing much here. In this case, we have equal highs. Liquidity above resides above equal highs in terms of the buy side liquidity and in terms of buy stops. Okay, so what the market will do, the market intends to trade down. We want first of all to clear its liquidity with about one candle closing above, or maybe just a wick. It's either there's a wick close for a particular time frame. Let's say this liquidity is either the candle has a wick close above it, or we have one candle closing above it, one bullish candle closing above this level, and before you know it, a bearish candle close back into the range. These are just ways that you can easily tell that the move is a manipulative move. So let's say this move actually manipulated this high, the stop loss is here, the buy side liquidity, clear the buy side liquidity by this move, and this move down is very significant, giving an idea that actually this has been manipulated, because it went higher and closed and came back lower into the range by this singular move, and it went up again, was unable to create a higher high. This is also very significant. This is what we call shift in market structure, or market structure shift in market structure, because we could not create this low that was formed, could not create a higher high. We have a shift in market structure, and this same particular low that could not create a higher high was eventually broken. When we have this broken, then we have what? A break of market structure. Okay, we have a break of market structure. This is very significant. When you have a break of market structure, you now look at this move. Expect that this move is what? This is what we call displacement. We expect that this displacement is huge. We want to see a very large displacement and possibly imbalances. Okay, let's assume an imbalance was created here. This is where you are going to take your trade from. The stop loss will be here, your entry might be here or anywhere within the imbalance. Then you take your trade downwards. So that's liquidity in terms of equal highs. We have liquidity in terms of trendline liquidity. This market is actually Was it in a downtrend or so? Price was actually approaching this maybe in an uptrend. Let's say in an uptrend. The market is in an uptrend, okay. And price was doing something like this. So higher high, higher low, higher high. Sorry about that. Let me just get a very good drawing. Something like this. So maybe the market is making higher high, higher low, higher high, higher low. Then we have another block. Assume that this actually led to the break of the structure here. Okay. Sponsored by this block. But meanwhile, we start forming trendline liquidity here immediately after this break. This is what we call internal structure. This is what we call internal structure. The internal structure here is bullish, okay, or the internal order flow is bullish. So you can be taking trades here and still getting good trades. But after the break of this major structure, major liquidity, okay, or this external liquidity, these are internal liquidity, internal liquidity, internal liquidity, internal liquidity. This is external liquidity. So after the break of this external liquidity, be very careful, because all of these can now be used as liquidity. Price can come, clear all the liquidity, tap into your order block, and buy. That's what we're saying. This is trend line liquidity. When you see a trend line like this forming, just know that very soon, all this liquidity, all the stop losses, sell stop that are here will be cleared by this move. So this is what we call the trend line liquidity. The trend line liquidity. Okay, that trend line liquidity. All right. Now this is the bullish scenario where we have approximately equal lows. The market came, cleared liquidity, trade back into the range, created this move that could not break this low, and so we form what? A shift in market structure. And then when this low is now broken, this is very significant, and we have a nice displacement, we start looking for imbalance according to ICT. Okay, this is the imbalance pattern. We start looking for what? For imbalance. Either I look for imbalance, or you can spot any zone that sponsor this break of structure, you wait for price to come back and you trade from there. This is the same thing, just another variant. You see the liquidity below these lows cleared, price traded back into the range, have a swing low, but in this case the swing low was able to create break structure, but then after that we have price trading back with a nice replacement upwards, forming imbalance. You can also do that and wait for this return to origin and trade the bullish move. Okay, all right, so we proceed. All what I've been explaining, I want to show you on the live chat, on the real chat, sorry, not live chat. Let's look at this carefully. We have, sorry, this downtrend, and eventually we have a change of character. After this stop hunt, so after this stop hunt, we have a change of character. Okay, and what do? We wait for the break of this swing high. Okay, like whatever I see here is just this. Price was coming down like this, break this, and traded up. We have a change of character, traded down, could not break this low, and eventually break this high. Exactly what we have been showing. And we now saw a very nice imbalance here. Price came. This is where you would have taken your trade and take it up. Just look at it carefully. You understand what I'm saying. I'm sure you understand what I'm saying. Okay. So price came, placed liquidity, traded back into the range. This is what we call change of character. And this is trading back to the range. We form this swing high here, middle of this 1, 2, 3 candles. But the swing high could not create a lower low. And eventually, when the swing high was broken, we saw a very nice other imbalance here. Look at the imbalance. And you can now trade the imbalance and capitalize on that move. Okay. Alright, so we proceed. Talking about point of interest selection, PY selection. For me, I usually like to select the whole of the swing that clear liquidity and break shadow to the downside. In this case, the whole of the swing. After selecting the whole of the swing, I'm rest assured that market will be trading within this range, within this block, before I will start looking for any form of refinement. But I'll first of all select this. This is going to be my focus, my area of interest, before I'll start looking for points of interest. Okay, so that's what I usually do, and that's what I would like to be doing. Okay. So, talking about that, I usually have 2 points of interest, 2 major points of interest. Now recall that in an upward move or in an uptrend, price is making higher highs, higher lows, higher highs, higher lows, and higher highs. While in the downtrend, price is making lower low, lower high, lower low, lower high, lower low, lower high, lower low. Okay, why am I saying this? I want to explain something. The 2 points of interest that you can try to master. We refer to them as the primary and the secondary points of interest. Okay, the primary and the secondary points of interest. The primary point of interest, first of all, we should know that this is the impulse correction, impulse correction, impulse correction, impulse. Impulse correction, impulse correction, impulse correction, impulse. I believe you understand this. The primary point of interest is the block or the point of interest that sponsored the impulsive move. Okay? The point of interest that sponsored the impulsive move. These are the primary points of interest. While the point of interest that sponsored the retracement move Okay, the point of interest that sponsored the retracement move is the secondary point of interest. So let me just make it very easy. Now this is a positive move. Our primary point of interest is going to be these ones, these ones, these ones. While our secondary point of interest is going to be these ones, something like this. Okay, just to make it clearer, use this diagram. Now this is downtrend. This is impulse, correction, impulse. Okay, that's clear. So any move that sponsored the retracement or the correction is the secondary point of interest. Why this move that sponsored this impulse is the primary point of interest. So why am I saying this? Because sometimes price tends to create shallow pullback. When we have something like this, we have a break and price does this, it's a kind of shallow pullback before continuation. But when price does something like this, break this level and pull back so deep, we call this one as what? Deep pullback. In the case of shallow pullback, price may be reacting from the secondary point of interest, while in the case of a deep pullback, price is most likely reacting or reversing from the primary point of interest. So that is why this POI selection is very key. The primary point of interest and the secondary point of interest. Okay, they are very, very key. Okay, they are very, very key. So if price may most times react from the secondary point of interest, but I always like to be safe. I always like to be very safe, and I always like to trade from primary point of interest. If I am ever trading from the secondary point of interest, I will be very quick to take my profits, because most likely price will come back to the primary point of interest and trade, sorry about that, and trade downwards. Okay, because there are liquidity still resting above here, price may still want to clear this liquidity and then trade downwards. Okay, sorry, it's like I'm getting so tired. This is well. Alright, so that's what we have. And how do you know? How do you begin to suspect that price may react from either the secondary point of interest or the primary point of interest? When you have this break and you see liquidity being engineered or created here or induced here, this liquidity, okay, most likely you know that possibly there's going to be a nice reaction from this particular block. Okay, but when you trace through and you start seeing liquidity close to the primary, you know that the primary might just be the one that price wants to go directly to. But like I said, most times you can trade from this and this, but you must be careful to quickly take your profit here compared to when you are trading from the primary points of interest. Okay, so possibly I believe we're going to see a live chart. Alright, this is a live chart. This is actually bullish. It's actually bullish because we have a bullish breakout structure here. This is bullish, and so, but after this, we now have what is bearish. The most recent one is a bearish breakout structure because it came down like this. So the most recent one is bearish breakout structure. So in that case, if we have a bearish breakout structure the point of interest that sponsored any move up, in this case, any move up, because it's bearish, any move up is what? Correction. So the point of interest that sponsored this correction move is what we call, is this secondary point of interest. Why this point of interest that sponsored the impulsive move is the primary point of interest. So you can see what happened. After price, this is what we can refer to as a breaker block, because this is supposed to be another block, clear liquidity break structure, but the other block failed to hold. So a breaker block is a failed, most likely the easiest way you can define a breaker block is a failed other block. Okay, so since this other block failed, because we are actually expecting that this other block will hold, take price up. But what happened? Price ended up doing what? Trading through. You can see that price traded through. So this is a failed other block, and we can refer to it as what? A breaker block. Now this move is a retracement move, because we're in a downtrend, and this move is impulsive. So this is going to be our primary point of interest and our secondary point of interest. After the break, you see what happened. You see a very nice reaction. This is what I'm saying. Okay, you can see a very nice reaction from the secondary point of interest. It's just like the break and retest for the retail concept. You can see a very nice reaction from the secondary point of interest. But what you should take note of is this. This move did not end up breaking the structure. And so if this move failed to break this low, and you start seeing signal that price wants to return back, then if you're in this trade, just take your profit. Most times, it's advisable to take your profit, because as you can see, price traded through and then break this secondary point of interest. When it does this, it's going finally to the primary point of interest, and we hope that price will actually take his move down. Okay, we hope. Whatever is here is what we have here. Price was making higher high, break of structure. Now we have a stop on here, a stop on, and you see what happened here. After this stop on, we created this low, and we have this break of structure, which is this break of structure. This is the break of structure, and we created some nice imbalance. So price might be coming here to sell from here. Okay, so we created a nice balance. Price is going. This is the secondary break of structure, so secondary POI and primary POI. It's either price going to react from this 1 hour primary POI, or price may just react from this imbalance section and start driving down. So this is an example of the primary point of interest and the secondary point of interest in action. Okay, so move on. Validating POI, origin block, extreme POI, the last point of true mitigation, they are all the same thing. They are all the same thing. Okay. If you want to validate a point of interest or another block, first of all, that block must have manipulated either a high or a low, or clear liquidity. That block must have grabbed liquidity. After grabbing the liquidity, that block should break structure to the downside. Possibly we have another candle that should really show the break of structure to the downside. Okay, that block should break structure to the downside. And after breaking structure to the downside, we should look if there is, FVG, that is fair value gap or imbalance created. All of these help to validate this particular order block that is here. but this order block actually is supposed to be starting from here. Okay, this green box. So the whole of this is the order block. This candle 1, 2, 3. The whole of these 3 green candles is actually the order block. Just that most times we refine it to the last candle, the last up candle before the sell. Okay, most times we do refine it to that point. Okay. Now we have mentioned stop hunt, we have mentioned break of structure, we have mentioned imbalance. We can still measure inducement close to the point of interest. If you see any inducement, you know that price may likely induce that, clear the liquidity above, tap into your order block and continue. Okay. Now the last one I didn't mention, but I just mentioned it now, is engulf. If you look at the next candle after this last institutional candle or the sponsored candle, this is what we call institutional candle or sponsored candle. This is what most people call institutional candle, IC, or the sponsored candle. Okay, so the next candle that comes after should engulf it. When you have it like this, it gives more validity to the order block. So we have stop hunt, break of structure, fair value gap, liquidity inducement close to the order block. Then the next candle that comes after the order block should engulf it. All of these will give more validity to our point of interest. And you can see that it did not only break the structure, it also went for that to break structure, which is very, very key. Break the external liquidity. This is what we call external liquidity. If it happens to break external liquidity, it makes it very, very key. And talking about if it has not been mitigated before, fully mitigated, then that is when we start talking about the last point of true mitigation. So if it has not been mitigated, it means that price will likely in future come and totally mitigate it, and then we can start talking about the last point of true mitigation for price to come, take it out and break the structure to the downside. Okay. Which POI should I trade from? Nobody really knows where price is going to react from. So what we simply do is to use the confirmation entry. This POI is important, this POI is important. This is the extreme POI, or we call origin block. This is drop, this drop, very important supply zone as well. This is important, this is important. So which POI are we going to trade from? We don't know. The only thing we can do is to check how price actually reacts when it gets to the POI, whether we have a change of character and a break of structure. For me, I always want to see a change of character and a break of structure before I enter and quickly take my short-term sales, as in this case. Okay, so this is the example we're going to be looking at. Let's say this is a point of interest. We want to know whether price is going to react to this point of interest or not. We see this move, price was in a downtrend, and we see this move, stop on change of character. At the time we see this change of character, I will now wait for another break of this high, which is break of structure. So when I get the break of structure, I can decide to trade from here and capture my nice move. Okay, that's just one way of doing it. Then again, you can still look at this move that is here on a much lower time frame. You can still go and look at this move. Okay, and that is what we are going to be looking at, so that we replicate what happened here, so that we look for change of character and break of structure before we enter. So let's see how it goes. So we have this. You can see it very clearly here. Let's go back. See. Alright. Okay. What we are showing you here is just the same thing with this, but just to show you why we selected here as our target because of this high. It's just the same thing as that. Okay. Just zoom in and zoom out so that you can see the larger picture. Okay. And this is when we start looking at this this particular move here. I want to look at this deeply. Scale down to the most lower time frame. This is this move. Okay. When you downtrend, what did we have here? We have the change of character here, break of structure here, and price can just come back. If we place our stop loss here, you can decide to get a better trade. Okay, that is if you want to refine further. So this one you have a better trade. Alright, instead of trading your stop loss range to be about this, now your stop loss range is smaller, not quite smaller, but appreciable. This is about 8 arrow, while the down is about 5 to 6 arrow. Okay, it's something not too bad. So with that, I think I've come to the end of this video, and I really do hope that you understand the points I'm trying to make. Thank you.